Okay, so once again, welcome to payroll. Okay? So, payroll. Now, introducing you to payroll. Your employees are going to be one of the hugest parts of your company, right? You got your vendors, right? People who you purchase items from or inventory, services, etc., etc. You got your customers, which are the people that you sell those products and services to. And then lastly, you have your employees, which help you sell the product or help you run your business. Okay. Now, once again, when we take a look at when a business has employees, we need to take a look at how, number one, is how are we going to compensate them? What taxes are going to be involved with having employees, right? What kind of benefits are you going to provide for these employees? And what deductions can they take from you? Okay? So that's a lot to deal with and a lot of concepts you have to understand. All right? Now, let's first start off by what the difference between a taxpayer identification number is versus an actual social security number, okay? So as you can see, we have a little example down below. A social security number is what is going to be identifying an individual, right? This piece of information comes from the Social Security Administration, and it's for an individual, and the way it's numbered is it's going to be their legal name with 3, 2, and 4 digits, okay? 3, 2, and 4 digits, okay? Now, this is how individuals can pay for their taxes, okay? And this is also how independent contractors, which we'll talk about in a few minutes, this is how independent contractors also file for their taxes as well at the end of the given year, okay? Whereas a tax employee identification number, or in this case, it's called EIN, which is Employer Identification Number, which is actually issued by the IRS. Now, what this employee tax identification number does is, this is what the company is going to use to file for taxes. So again, when you start up a business, you have to pay for state taxes, you have to pay for business and licensing tax. You also have to pay for income tax, because as a business, you need to pay your dues for running a business in in the country, right? You need to contribute your earnings to society. So in this case, the IRS is going to be distributing you a tax identification, an employee identification number, which looks just like this. It's going to be indicated with 2 numbers first, and then the 7 digits fall right after. Okay, so that's the difference between an individual social security number and a employee identification number. So once again, this is where the IRS is going to be collecting majority of all of their taxes that are computed for a company, and they're going to use this number. Okay. Now, let me give you a little note here. As a sole proprietor, you have 2 options. You can use your individual social security because, once again, you and the owner are one. But that doesn't mean you are not able to obtain an employer identification number. You can get one, and you should get one, because you definitely want to make sure when you file taxes at the end of the year, whether you run it on a calendar basis or a fiscal year, you want to keep your, once again, personal information separate from your business information. So the perfect example would be creating or applying for a business employee identification number. Now, once again, you can use a social security number if you are a sole proprietor. but they do recommend you to apply for a business employer identification number. Okay. So once again, employer identification number, how do we apply for one? So here is a form from the IRS themselves, okay? It's called the IRS SS-4 form, okay? This is how you can apply for a legal, basically a legal card that says that you are a legal business and you're going to be applying for this exact identification number. So you get a unique business identification number. Okay, so it's just like a social security, except you're going to apply it. Okay, now once again, before you can do any of this stuff, you need to first apply for a business license to the state and to the county that you are doing business in. Okay? You need to obtain that license first before you can apply for a business identification number. Now, nowadays, they make it so much easier. When you apply online, right? When you apply for a business license, you are also applying for the identification number at the same time. So in this case, they kind of give you, if you get approved, you get your business license with the employer identification number already created for you. Okay, so that's the great thing about that, is that when you apply online, not only is it going to apply to the state, it's also going to apply to the county. And it's so much easier to do it now. It's you just go online, you apply whatever you want to do business as. You could apply as an LLC, but you can't apply as a corporation unless you are established already. All right, unless you want to franchise. Okay, but once again, those licenses, depending on what it is, if you do a sole proprietor, it's really easy. It's very simple, right? We talked about how to create one. It's only $100 if you want to create a business here in Nevada. Okay, so that's just a little FYI. So once again, if you are doing this on your own, the SS4 form is how you apply for a business employer identification number. Okay, so once again, it's going to, create all those for you. You absolutely need to have it for these main things too if you're selling a particular item, because you will be special taxed. Okay. All right, so then now let's actually dive into what employees are, right? There are a total of 6 employees that we know as of today. Now, if you want to learn more, because there is actually more than just these 6 that are on this list, if you want to learn more, I encourage you to go to irs.gov/publication15, because that's going to give you a list of every single employee that exists, right? There's employees that are family members, okay? There are employees that are green card holders. There are employees, so on and so forth, right? But here, I'm just going to give you the basic 6 that you see today and common ones that you see today, all right? Whereas an employee who's a family member, you don't see that as often, unless, a mom and pop shop is going to be created, right? And then we don't talk about individuals with green card holders or that have the visa that allows them to stay in the U.S. and that they can get a temporary a Social Security so they can work. We don't talk about that, but those people do exist, all right? Now let's go ahead and talk about these 6 common ones that you normally would see on the daily, right? We got your common law employees, your statutory employees, your statutory non-employees. You also have your independent contractors, your leased employees, and last but not least, individuals referred by a temporary agency. Okay? So number one is going to be your common law type of employee.
Excuse me. What is statutory?
I'm going to talk about that in the next one.
Oh, okay.
Okay, yeah. Okay, so first let's talk about common law. Okay, common law. All right, the way that we determine that this is a common law employee is any standard typical person that does a regular, if they are, whether they are salary or wage based, right? They are a typical person that goes into work, clocks in, do their job, and clocks out, right? Now, what are they told to do? Is exactly how you determine them as common law. It's because you control exactly what they do, how they do it, when to do it, and exactly what to do. Okay, so you're gonna be, the employer is gonna be providing a specific task for this particular employee, tell them when to do it, how to do it, and give them all the supplies in order for them to be able to complete the task. So everything must be provided, okay? So that's how you determine what the common law is, that they are told exactly what to do. So for example, anybody that goes in and clocks in from 8 o'clock to 5 o'clock, and usually when you apply for a position, you're given all the list of tasks and duties that they are limited to, right? They're not limited to do more than that unless it says right there could potentially be additional tasks, okay? So again, that's how you tell the difference between all the employees, is that the common thing is that you are telling them exactly what to do and how to do the job. Okay? So exactly, especially when you are a company that provides the service or provides a good, you're going to tell them exactly how the job is going to be performed. Okay? So once again, these are your regular people that are salary based or wage based that come into the office, clock in from 8 to 5. They do their job because they're being told exactly how to do it, when to come into the office, and they are given everything that they need to complete the task for. Okay? Now, statutory means it's through the statute, so law. Okay, so statutory employees, okay, they're similar to common law, okay, except there's only a small criteria, okay. Now, usually a great example of a statutory employee is going to be someone who works for you, but they are like a delivery person for you, okay. Now, they don't have to come into the office at exactly 8 o'clock to clock in. Their only job is to either, potentially work for you, right? They are a full employee to you. However, their job details doesn't really go as expensive as someone who's a common law, okay? Now, if you think of it in a scenario, if it's a delivery truck driver, right? Their task is to deliver point A to point B. They're not required to come in at exactly into the office and actually clock in and clock out, right? They are only scheduled to come in or to go to the delivery truck. They complete their task and come back when they're done with the task. Okay, they're not given a specific time frame, but they are scheduled specific dates of when they need the stuff to be done. Okay, so that's the kind of difference here, is where your common law, they are told exactly you clock in at 8 and you clock out at 5, where statutory employees, they are scheduled to come in one day, drive all this stuff, deliver all this stuff to this town, All right? And whenever your day ends, you tell me when your day ends, because especially with driving, it's that's where it fluctuates, right? Because you can never predict the road. Accidents happen all the time. So that's why it's a scheduled thing versus you have to come in every single day from Monday through Friday, 8 to 5. Okay, so truck drivers, which is a great example, they are part of the. They're going to be told exactly what to do, but their job isn't required to tell them when. It's going to be scheduled, and how they do the job. Well, I mean, in this case, right, the task is a lot simpler. It's not as complex as someone in the office, right, who can do multiple jobs. This one is one specific task. All right. And how did they do it? Well, you're going to be providing them the truck. So in this case, you're still providing the stuff. However, the way that they're going to be coming in and the way that they're going to be doing the specific task is going to be scheduled, or it's going to be whatever that specific task is. It's a simple task. All right. So that is that right there. Okay.
So in essence, what they are is a contractor that is treated as an employee.
No. They are a full employee because they work for your company, not a contractor, because we're going to talk about independent contractors after this.
But you can, okay.
Yes, there are, yes, you can. But once again, these are full employees. Now, for example, right? I can have this person, let's say my company, my service is that I pick up laundry and I clean it and I have it sent out. That person has to go out every single day, pick up laundry from other places, bring it back, we clean them, and then they get delivered the next day. So that is someone that's going to be constantly be using. They're not, and it will depend, right? You can have them as a contractor, but in this case, the delivery truck person is just an example of how a statutory employee can operate. That's just an example, right? They can go beyond the limits, right? It's not someone who works in the office and has a huge list of tasks they can do. It's geared towards one specific task. So, for example, if a company has a sales representative that travels, they work for the company, but they're not obligated to come into the office exactly at 8 to 5. Their job is to go out there and become a sales representative and travel and sell our products. Okay? Yes, you can, if it applies, if they want to be an independent contractor. But once again, how I'm trying to explain this concept right here, a statutory employee, is that they work for the company, but they're not told when to come in at all times. They're scheduled. Hey, go to this meeting. I booked you a flight. They are told what to do. They are told when. But the difference is that they're not the person that has to come into the office at exactly a specific time and a specific day. Okay? And their job is simplified. It's narrowed down. Okay? So that's a statutory employee. Okay? Any questions there?
Yes. Are you recording this?
Yes, I am.
Okay, good.
Let me double check. Yes, I am.
Okay, thank you.
Mm-hmm. Okay. So now, what is the actual difference between a common law and a statutory employee? Now, this is in terms of taxing, okay? Because we already discussed the difference between a common law and the statutory, right? Now, here, common law employees get taxed, not twice, but they get taxed for the individual level. Okay, so they are going to be subject to federal income tax withholdings. And on top of that, they are also required for employers to pay into their Social Security and Medicare, which is FICA. And we'll talk about FICA after the break. Okay. Whereas your statutory employees, right, they are not required to pay or be withheld for income tax withholdings. Okay. However, because they are still treated as an employee, you still are subject to have to pay into their Social Security and their Medicare. Okay. Reason being is because, once again, because they're considered statutory, they're not required to come into the office every single day. Like as someone that's a common law, right? You're scheduled a particular time frame, but you're not obligated to have to work. So another example would be an airline hostess. They're not obligated to fly every day. Okay? They work for the company. They get great benefits. However, they don't need to work on the plane every single day. Okay? So that means if you are considered a statutory employee, you are not subject to have to withhold federal income tax withholdings, but you are subject to pay into their Social Security and Medicare. Okay. Now, most cases, all the examples that I gave you for statutory employees, most oftentimes they're very, very similar to common law, that sometimes they just mesh together and they just become common law. Okay, so that is an indicator there. That's just the difference on how you withhold their taxes and so on and so forth. But most cases, they just treat them all as common law. Okay. All right. Any questions there? Okay. Now, let me go ahead and give you a reminder. Employees. These two right here, statutory employees and common law, are the only people that are going to exist on your payroll. Okay? Everybody else is going to be a mere expense to the company. Okay? And we're going to start diving into talking about the other 4 types of employees. So we're going to talk about statutory non-employee, and then we're going to talk about independent contractors, because these two are the common ones that you actually see nowadays. Okay. Now, a statutory non-employee, okay, they are treated as a self-employed individual. Okay, so that means all federal taxes are subject to the person, that is because they're going to be considered as a self-employed individual. They too are going to be using the 1099 form, except they need to check themselves as a self-employed versus an independent contractor. Okay, so these individuals here, okay, great example is going to be a real estate agent, right? It is a place where you have like an office, right? And these individuals, they work as a group together. However, they determine when they come in, the clients that they handle, so on and so forth, right? At the end of the day, they're working together as a group, but they provide individual services, because at the end of the day, again, they're given the task, right, to sell homes, right? If I use a real estate agency, if their job is to just sell homes in general, right? They get commissions, so on and so forth, and they work for a company. Okay. But once again, these ones, they're not obligated to come in every day. They come in on their own time. They come in for whatever task that they need to come in for. They're the ones that are, sales representatives, are perfect examples of statutory non-employees. Okay? Where the difference here is, for an independent contractor, once again, they're still going to be filing as an independent contractor. They are the ones who control the end result. Okay? So in this case, right, a real estate agency, their end goal is to sell a house, right? No matter what it is, they all need to be on the same page and sell a house. Where an independent contractor, such as a doctor's office, there's a whole group of doctors in the office, but every individual that is there provides their either some of them provide their own tools, but most cases, a doctor's office, it's all the same. However, each individual person provides an end result. So hence doctors, dentists, right? Veterinarians. That's why you can go into one doctor's office and see 3 different doctors, and they're all going to give you 3 different opinions. That is an independent contractor, right? The end result is going to be different. However, their task is going to be the same, right? If you're going to be coming into the doctor's office for one specific thing to get it, to check you out, then their task is all going to be the same. Now, again, how they come into the office is whenever they want to. If they're booked out appointments, right, because they have the person in the front office booking out those appointments, they come in when they please. If there's clients available, they come in whenever they please. The end result is different. Anything that's given to them, it depends. Some independent contractors must bring their own supplies. But again, if it's a doctor's office, they all contribute to all the supplies so it looks uniform, right? So that's the difference between a statutory non-employee and an independent contractor. They're still going to be filing the same 1099 form, except on that form, it gives you a checkbox to say, are you self-employed or are you an individual independent contractor? Okay. Then we're going to talk about now the last two, which is a temporary agency versus a leased employee. And now this one is very, very common here in Vegas. Okay. Temporary agencies, okay? Pretty straightforward. It's where you go to a headhunter or some kind of work agency that that gets work for you. They get paid by the big bucks by the major companies to work on a project. So in this case, just like in the title, it's a very short term work, labor, job, whatever you want to say it. So it could be a project that could be 3 months. It could be a project that's only 1 year long, 2 years, 3 years, 5 years, right? So that is the difference between a temporary agency, that it's usually provided a project, and it's where each individual that works for the temporary agency, they're going from job to job to job. Okay, and here is here is how they pay the workers. You do not pay the workers. You pay the agency. So you cut them a check, say, hey, I'm going to give you $50,000. I need 2 people to work for me for this project. And I'm giving you $50,000. The agency is going to pay for the employees. Okay, so the individuals that work for the temporary agency, they're getting paid by the temporary agency, but the business itself pays a temporary agency a lump sum money to get a project done, to find the people to do the job for them. And that's that one, all right? Now, temporary agencies and leased employees, they are kind of similar and can be connected, because oftentimes there is a possibility where, hey, I'm going to pay this company money to help me find some potential employees, and if they do a great job, then I'm going to buy them out of the temporary agency's contract and employ them on my own. And that's called a leased worker. So you're contracted right? Depending on if you're contracted to the temporary work agency and you get bought out by the company that wants to buy you out from their contract, and that's going to be considered a leased employee. So most leased employees are going to be working for the temporary agencies, and it depends on that company. Are they seeking for potential employees? And if they are, then that's where they can, you know, get that person out. But when you're a leased employee, you are contracted to do what the task is told. Whatever the job, project, etc., you need to show up this day, etc., etc. Okay? And same thing here. The company that got these leased employees, they do not pay them directly. They pay the agency or pay them as a mere expense to the company. Okay? And then the company pays them. All right? So that's a huge difference between a independent contractor, because an independent contractor, they go and look for their own jobs. These ones, big major companies, they look for people to provide these temporary jobs. And these temporary jobs, once again, can be scaled as 3 months, 6 months, a year long, and they're going to be hopping from job to job to job. So in this case, right, temporary work agencies are going to have a constant pool of jobs that a person can do from here to here and here. Whereas an independent contractor, you need to gain all those clients. You need to gain all those people. You need to gain that work on your own. All right? You may have days where you won't work, but that's because you need to go out there and, you know, market yourself and gain your clientele list. Where this one, you already are provided a job because the big companies are paying this company to find people to do the job. All right. Now, again, right here in Las Vegas, there's a lot of temporary work agencies here, especially for MGM, Caesars, right? All of those they pay the big bucks to just find people to just work for them. And it could be a small project, right? Small projects such as they need to set up a diner there, or for example, I have a grand opening. I just need them to temporarily serve people, or they have an event that they're creating, so they need temporary work agents, people to just serve, you know, a banquet, right? That's what these people are, right? Any questions here? Okay. These four, so temporary work agencies, leased employees, independent contractors, and statutory non-employees are not going to be on the payroll. So that means I just wanted to talk to you guys out there, because sometimes it's actually so much easier to actually have an independent contractor or just pay a company to work to find these workers for you. It's so much easier, and it's actually cost effective, because you're not having to pay for benefits for them. You're not having to pay anything for them except cut them a check and say, this is what my expense is for this month. Okay? Or this is the expense that I'm going to pay you for. All right? Any questions?
Can you repeat that last again, please? I'm sorry.
Okay, so these four people, right, are going to be options for businesses to actually want to obtain these kind of individuals, because it's cost effective, because one, you don't have to pay into anybody's taxes. You don't need to withhold anything for the company. You don't need to be responsible for paying for any of the benefits, because all these four people are going to be mere expenses to the company. The company is not responsible to pay anything except for just getting the job done. All right? Every individual here is going to be subject to have to pay into their own tax, or have, because most most temporary people or leased employees, they're 100% either going to be independent contractors. Okay, so they all kind of intermingle with each other. But at the end of the day, none of these, you are not responsible for paying into any responsibilities for them because they're not an employee. They're just a mere expense to your company.
Got it. Thank you.
All right. Let's go ahead and dive in the payroll process. So once again, only our common law and our statutory employees are going to be the only two people that are going to be under our payroll. So how does the process work? Here are the steps that you have to take, all right? You need to, it's going to be split into two separate taxes that you have to actually compute. One of them is going to be for setting up employee taxes, and then you're going to be having to deal with employer taxes, okay? So once again, we're going to talk about all these steps in the next couple slides. Okay. So of course, before anything happens, you need to, as an employee, you need to do your measures to properly get them into your company, right? You need to have them apply for the job. Once they get the job, you need to run a background check, run their social security to see if they are a legitimate individual here, like a citizen, a U.S. citizen here, because there are rules and guidelines if you have someone who is not a U.S. citizen that's working for your company. Okay, you need to be able to run all that stuff in order for you to successfully have them as a full pledge employee. Now, in this case, right, this is what you have to do. Once you officially have them as an employee, you need to do your duties and report to either the state, the local agency, or some kind of agency. So in this case, in the state of Nevada, you have the Nevada, which is called DETR, which is the Department of Employee Training and Resources, or I put rehabilitation. That's it's supposed to be rehabilitation. That is DETR. Okay, if you guys are familiar with DETR, that's also going to be the place where all of the businesses that are in Las Vegas are going to report their statuses on the employment. Okay, this is there's also places where you can go to the IRS little bureau. You can go to there and they just go ahead and let the DETR also know about your change in employment. Okay, so this is how the office, which is the DETR, this is how they know that there's a bunch of jobs available, because they are the Department of Employment. They know how to find these jobs for these individuals. They know where to get the training, etc., because they are being reported by the companies, right? Companies can tell them, hey, I'm looking for some people. Here, I'm going to send you a bunch of, help, or, I'm looking for employees, okay? So that is one of the resources that you can use. Now, once again, you need to report to them, and you're going to be applying a W-2 form. Now, be careful. There are two types of W-2 forms. There's one for the employer, which is going to be sent to this bureau right here, or the IRS, depending on who you want to go to. And what this one is for the employer standpoint is, this is how you're going to be submitting out their information, giving them details of who they are, what's their legal name, what's their job, when is their start date for working, what's their social security number. You need to get all of that information, because this is how you're letting IRS know how they are going to be taxed, all right? And you're going to let them know, are they a common law employee, or are they a statutory employee? What are they wage rate, or are they salary based? All of that information is going to be posted in here on the employer's W-2 form. And this is where when you run this report at the end of the given year, that's where the employees get their W-2 forms from the company, is because of the company submitting this form to the IRS or to this local state agency. Okay, that's how you let everybody know that you have employees. You must legally document this. Okay, because if you don't, and the IRS finds out that you're paying somebody under the table, you can get in trouble for that. So that's why you have to fill this W-2 form as an employer to let everybody know that you have employees, and you must fill out every single detail. Okay? Once you've done that and they're finally into the system, that is where we are going to take a look at collecting W-4 forms from your employees. Now, once again, W-4 forms are very important because this is what you're going to be submitting to your employer, okay, as an employee. This is what you're going to be collecting from your employees because this is going to tell you how they want to be taxed, all right? Because once again, what a W-4 form does is it allows the individual to claim some taxes to be tax exempt, or in certain circumstances, they can claim things such as their children, right? They can claim deductions so then when you withhold their income tax, you don't hold as much, all right? Or you don't withhold them for the maximum amount. So this W-4 form is more or less important for the employee to submit to you, because if you don't submit this to your employer, you're going to be automatically assumed that you're going to take no withholdings, that you're going to be taxed at the highest bracket, and you're going to be also taxed as a single individual, okay? Where this will tell you how you want to be taxed out of how you want your income to be withheld. All right, so let's go ahead and take a look at this new W-4 form, okay? And for those who are going to be, so you guys, since you guys are going to be applying for the job in the future, you guys need to know this one because this is a new form. All right, anybody who has or who were employed 2018 and prior, the form has completely changed. Okay? Completely changed. As of 2019, 2020, and 2021, they all are starting to use a brand new form. Now, in 2019, it's similar to 2018, except it has a little combination of the 2020. However, now that we are in the year 2021, this is going to be your W-4 form that you must fill out, okay? Now, the website has changed a few bits. If you go to irs.gov, they do have what's called the tax estimator, which actually that website has actually changed. It's supposed to help you be able to fill out your W-4 form for you, in case your employer isn't gonna do the fill out the W-4 form for you. Some of them do for you, some of them don't. So they do have a tax estimator on the form, so you can maximize all of the amount of tax deductions you can. So it allows you to claim as much as you can versus actually having deducted everything, or being taxed for the full amount, and then then be subject to get a return. So in this case, the IRS actually helps you out to kind of gain all the money that you can, which is quite weird because you would think that the IRS would be coming after you for your money, but no, they actually help you save your money. But how they get you is that the more taxes that you claim, or the more withholdings that you claim, that means they're going to be getting a lot of money at the end of the day too, because you have a possibility that all the money that you're going to be receiving from the company, you're subject to pay all of it back at the end of the year. So I kind of see where they kind of got to it, because they're saying, hey, take all the maximum claims that you can, because at the end of the year, you're going to end up paying me back anyway. So that is the IRS for you. But what this does is, once again, this tells the employer how you want to be taxed. So first off, straightforward, you need to fill out your legal information. You need to claim one of the three. There's only three options you can claim now. It's either single or married but filing separately, or you're going to be married filing jointly, or the last one is going to be head of household. Okay. Now back then we got to claim withholding. So every single one of these is one withholding. Okay. Now it's not going to be considered a factor here. We don't care about what one withholding does. We care about the per dollar basis. Okay. So that's where this whole entire form changes. So here, automatically, you need to claim what filing status you're going to be. Second part is going to be, now again, with the vast majority of today's society, right? Any individual can have multiple jobs, right? They can have a primary, a secondary, I think it's called tertiary. They can have multiple jobs, right? Especially with the idea of, they can work their regular 9 to 5 that's their primaries, their regular 9 to 5, and then in the evening they can go ahead and do some Postmates or some Ubering towards the night. They can pick up any shift, okay? It doesn't have to be Uber or Lyft, but with the idea of having Uber and Lyft, right? It's making it more available for individuals to earn as much income as possible. So with that being said, this is where step number 2 is going to ask you, tell me, do you have more than one job? And if you do, tell me how much do you earn from that job? So in this case, right, now back then, if you had multiple jobs, just due to just how the earning worked back then, right? If you had a full-time job and then a part-time job, right? You would have to do separate W-4 forms for every employer. In this case, you only need one. You only need one. Now, this is how they also keep track of you and making sure that you are claiming every penny that you are earning. Okay, so then in this case, they're boggling down and keeping track, a closer track on you. And if you're married, your spouse's their earnings are going to also be applied here as well. So if you said that you are married and you're filing together, their income is also going to be recorded here. Okay? So they want to know every single dollar that you're earning for your household. Okay? And once you do that, okay, then the next step is going to be claiming any dependents. So once again, the rules are, if you have a child that is under the age 17, they're going to cost you $2,000 per year. Okay, now that's very little, but that's just how the system works. Okay, they're gonna treat every child that is a dependent as $2,000 per year. And same thing here. If it's a dependent, right, that isn't your child, but someone who needs who's depending on you, it's going to be, you can claim up to $500 per individual. So here, there is no cap, all right? Back then, your cap was you can only claim up to 10 children, Okay, in here, there's no cap. Now, once again, that's the step 3. Last thing is going to be if you own any stocks, any treasury bills, anything that's considered extra income, or anything like that, you need to take it out. Okay? And then any other deduction. So if you own a home, that's a deduction. If you anything that's I believe that's the only one I really know. You can take a lot of deductions. So once again, the best person to talk to you about this is going to be your tax accountant, because they're going to tell you what benefits and what deductions you can take and what you want to claim from your employer. Okay? So once again, all of those are going to be the new 2021, and this is what you guys are going to be filling out. So once again, this is a lot harder. So that's why they created a tax estimator, which helps you answer all the questions that you need to answer, and it helps you fill out your W-4 form for you. Okay? All right? So that's that one for you. Okay? Any questions in regards to the W-4 form?
No.
Okay. All right. So every employee must submit this to an employer, and if they fail to do so, then you are subject to tax this individual at the highest bracket, single, not filing, married, or head of household, and you're going to tax them at 0 withholdings, meaning they're going to be taxed at the maximum amount of tax. Okay? But that's a good thing, because at the end of the day, you're more likely going to get a tax refund. Okay, versus for someone who claims so much at the very beginning of the term, they're probably going to have to pay into their taxes. Okay, now yes, there are rules and regulations, especially when you put in all that in the very, very, very beginning. Like you say, hey, I'm just going to file my taxes as normal, as a single, whatever, and at the end of the year, that's where I'm gonna submit saying I want to claim my children, yada yada yada, claim my house. That's where, you have the possibility to claim at the end of the year. All right. Now, once again, I'm going to tell you this. I am not a tax accountant, so I can't tell you any more than what I know so far. But again, if you are interested in learning all about this stuff, your best friend is to go to irs.gov or go to some kind of tax agency, whether it's like H&R Block, or I can't remember, JP Morgan, anybody that does taxes, and they're going to give you all the details on what you can do. Okay? All right, so the next thing you got to determine is going to be how frequent are you going to be making payments to your employees. So as far as this, the more common ones that you'll see or something are more like weekly, bi-weekly, and semi-monthly. Okay, things like people like Uber, Lyft, you can claim your earnings at the end of the day, so they get paid at the end of the day. All right, that's just an example. Weekly, right? Some people get paid every Wednesday, or they get paid every Friday. All right, that just depends on your company if they can afford to pay you every week. Now, most cases, right, a very standard, basic kind of job is going to have a bi-weekly or a semi-monthly. Bi-weekly is where you get paid every 2 weeks. So therefore, in grand total of at 1 year, you're going to get 26 paychecks. Okay? Where the difference between a bi-weekly and a semi-monthly, you get paid exactly twice a month. So on the 15th and at the 30th or 30th day. Okay? So that means they're only going to get 24 paychecks. Okay? And most semi-monthly individuals, they're salary based. Okay? Most of them are salary based. Okay? Where bi-weekly is more for your your wage based. Okay. Now, again, it depends on your company. If they want to just put everybody on one single schedule, they can. They can have individuals where some of them are bi-weekly, some of them are semi-monthly. So once again, it's depending on the company that wants to how frequently they want to pay their employees, right? Now, some people also use the monthly. Now, as far as this, it's very rare just because monthly is kind of harder to get by, just because we live in such a society where money is predominant, and a monthly paycheck is not something that can be super doable. Okay, but agencies that work for the government usually they issue paychecks on the monthly. Okay, so any government agency that you can think of, they usually distribute checks on a monthly basis. Okay, I believe workers' comp also do monthly paychecks as well. Okay, then you have quarterly, which means they get paid every 3 months. So these are more for your big owners, chairman of the company. They are probably going to most likely get paid every quarterly, every half year, or at the very end of the year. Now, again, these are going to be people who are higher up in the company where, one paycheck could be tens of thousands of dollars. So that could be definitely easy to live off of. But once again, they're not as common as your regular workers that would normally claim either a weekly, bi-weekly, or a semi-monthly. Okay. Now, again, most salary-based people are going to give them a base estimate of their annual earnings. But that doesn't mean they get paid annually. It's just an estimated amount. Okay? So once again, these are all the payroll payment frequency options that you can claim at for the status of every company. Okay. Now we are finally going to now dive into what compensations that are available for each employee. You have a question?
Yeah, I have a question. What about like what is the benefit to like presidents and governors that say that they are going to do the job without getting a salary?
Um. Okay, so you're talking about like nonprofit organizations, or are you talking about just those people who claim that? Because honestly, they're gonna get paid no matter what.
Yeah, because I've heard the president and I've heard governors, and like in California, they said that they like Trump, not Trump, but Schwarzenegger. He said he was doing the job without a paycheck. What's
Well,
the benefit to that? Are they getting their money some other way? Or are they?
absolutely. They,
Oh, okay.
they say that so then it looks good in the public eye, but most cases they're getting paid. They get it, by, taxes, right? They get they do get the money, right? A lot of these things, because they're the governor, they're already paid for in advance. Because again, what is it? Sponsorships, things like that, right? People who say, "Oh, I'm going to sponsor the governor to come here." It's a paid event. They're being paid for the governor to come here. So everything. So in this case, like that kind of answer, they do get paid, but whatever they do with their tax dollars is going to be whatever they're subject they're due for. Now, I don't. Now we all know Arnold. He has his other income from his movies, so he doesn't even need the money. But they claim that just to kind of give them a good viewpoint in everybody's eyes to trust them and say, oh, instead of paying myself, I'm gonna take all those tax dollars and pay it somewhere else. All right. Now again, it may be true to some point, but they actually do get paid regardless because
Okay.
they're getting their money from the government regardless.
Okay.
Mm-hmm. All right. So now we're going to talk about how employees can be compensated. Okay. how can they earn money? All right. And there are two kind of ways, right? They could either be paid as a regular hourly wage or they could be paid as a salary. Okay. So the difference between an hourly wage and a salary is that, of course, you are earning by the hours that you commit to the company, right? If you're clocking in 8 to 5, then that's your hours right there. So once again, you're getting paid by the hour. Now, as far as that, some benefits, depending on whether you're a full-time employee or whether you're a part-time, you can have other means of earning money, such as you can earn doing overtime, okay? Or if your company offers any benefits or commissions, okay? You can yeah, so that's pretty much you can do here is that you're going to be basically earning an income based on the hour, okay? And usually it is going to be based off the state minimum wage, okay? So I think this minimum wage actually changed recently. It's no longer $8.25. I believe it's $9.75 or something like that. I haven't checked it yet, but I know for sure that the minimum is no longer $8.25. It was for back in 2019. But 2020 it's gone up because of the pandemic. Okay. And again, people who are actually exempt from the minimum earnings is going to be anybody that's a tipped worker or anybody that's a professional. Okay, because in this case, a tipped worker, their minimum can fall below the state minimum because at the end of the day they have to claim their tips as part of income. Okay, now a lot of people here in Vegas are tipped workers. Okay, they have to claim their tips at the end of every shift. Okay, so that's just a little idea here, but most people that are going to be earning are going to be based on the clock, based on the hour that they contribute here, and how they can earn is through overtime or if they have some kind of bonus or commissions. Okay. Now, for salary-based people, it doesn't matter how many hours that you claim, right? In this case, you're going to get a one flat check every so often, okay? Depending on how you get paid, right? Because at the end of the day, no matter how much money you, no matter how much time you invest in the company, you're still going to get paid the same amount, okay? The only extra stuff that you can earn here is if the company offers bonuses and commissions, okay? Overtime pay, which again, if you go beyond, usually the average is 40 hours. If you have that or do after hours, so anytime after the day is over, that's going to be considered overtime. So again, those are some options, but once again, overtime could be one of those factors that could not be available to you just because as a salary-based earnings, it doesn't matter how much time you invest. If the job gets done, the job gets done. If it takes you longer to get done, you're still going to get paid the same amount. Okay? So that could be an optional idea here, right? And that's how we compensate our employees. Okay? Oops, sorry. Now we're going to talk about what the employee paychecks are going to, like things that could be considered deductions or benefits to the paycheck. Okay? Now, things like that could be any fringe benefits. Now, what is a fringe benefit? So, for example, So, like for example, right? If your company is a large company, so they're so large that they get offered special discounts for specific places. So, for example, right, um, a, a large company could have they use AT&T, right, or they can have auto insurance, right? Usually AAA members, right? And if they go through the employer to get these extra benefits, right? Right? So, for example, the AT&T, if you go through your employer, you get a special discount because you work for that company. That's going to be considered a fringe benefit to you. Now, most cases, fringe benefits are kind of like a membership tax that you guys have to take out from your paycheck, and that's just for because you get these fringe benefits. So it's a small price you have to pay out of your paycheck to be part of the fringe benefits. And if you don't pay into it, unfortunately, I believe you don't get those fringe benefits. So it's kind of like uh, I forgot what they're called. Um, but this kind of idea, right? You pay into the system, and that system will benefit you back. All right. Holiday pays, right? Those could be something that, especially here in Vegas, a lot of the time, they will not pay for holidays. So if you take that day off, you actually might get it deducted from here. But in this case, holiday pay could be something that could be a benefit to your company, to you in the company. Maybe you get a Christmas bonus because it's a holiday pay. You could get vacation pay, so PTO, personal time off, or paid time off. Okay, you can get paid to vacation. You can even get paid for, taking a sick day. All right. Other things to do is any retirement benefits. So any 401ks, any medical insurances, life insurance, home insurances. I know a lot of companies, especially the major companies, they do provide it. Both medical, dental, vision, life insurance, they got it all. Okay. And those are just basically possible deductions that you could take away from your paycheck. So these are all things that you're going to actually pay into, or they can go for you. So if you claim a sick pay, you're going to earn that. But if, let's say, you pay into your vision or dental insurance, you must pay that out from your paycheck. Okay. Now, other things right here on the right side just pretty much tells you how you can clock in your hours, right? If you are a regular wage person, some people are salary hourly, meaning they're on a salary basis, but they still want you to clock in your hours because they're going to pay you regardless of how many hours that you do. So if you claim more than a specific amount and you go over, then that's where they offer you the overtime. But that's only depending on what the company is, right? And whether they offer that to you. So once again, these are means of how you can keep track of your hours and so on and so forth. Okay. Now, we're going to go ahead and dive into employee taxes. Okay. So when we talk about employee taxes, there are actually a total of, right now in the state of Nevada, there's only 3 taxes that you're commonly to know for. Okay. In this
Excuse
class,
me. Nathan has his hand up. Do I delete this? It says open queue. Nathan has his hand
Oh,
raised.
I'm sorry, I forgot about that. No, I was gonna tell you earlier that you should not trust the politician. So
Okay. Yes,
that was before
never.
Q.
Yes. That's what I was saying that about earlier. Yeah, sorry about that. No, yeah, I completely agree. But once again, we're gonna leave that. We're gonna leave that behind. But yes. Um, you can ignore that. Now that's a new feature because I paid for this service. I paid for this Google Classroom, so they have that new feature where you can do the hand up. But That's okay. But I can't see that just because I'm viewing the PowerPoint right now. Okay. All right. So coming back to
Okay.
this. Mm-hmm.
All right.
Mm-hmm. So now we're going to talk about the 3 things that are going to be considered something that you must tax your employees for. And the first one's going to be your federal income tax withholdings. Okay. Also known as FITW. Okay. Every person who's an employee is subject to pay for this. That is exactly why you have your individuals submit to you a W-4 form, so they tell you how they want to be taxed. So it's going to be based on how much earnings that they do. So the higher the wages, the higher the earnings, the higher percentage they're going to be taxed at. Okay. So once again, this is the individual's duty to contribute to society by working and paying into taxes. Okay. Now, once again, how do we determine all of this? So once again, you need to have the individual's W-4 form because that's going to tell you how you're going to be taxing that individual. Okay. Now, there are 2 methods on how to calculate or to determine FITW. And guess what? I'm only going to teach you one. You're not going to learn about the bracket method, okay? Because it's tedious. It's even worse than the percentage method. And the tables go on and on and on. All right? And I'm going to show you what tables I'm talking about in a few minutes. But when you're doing these kind of methods, these branch out from this circular E table, which is a tax table, all right, that the IRS has submitted to you guys. Now, once again, this idea is coming from a manual employee tax perspective. This is us. We're going to learn here today how to properly manually calculate tax for each individual. Okay. Now, once again, you got people who can do that for you. Okay. You got payroll services that you can pay. But once again, if you pay those people, it costs a lot of money. All right. But they are the professionals. But for here in this class, I kind of want to let you guys understand how much taxes are you actually going to be taking out. Okay. So once again, we're going to take a look at the percentage method, which we're going to be looking at a circular E table. Okay. So what is a circular E table? It looks something like this, right? Where each table is going to be based on a criteria. Okay, it's going to be based on your filing status. So are you married or are you single? Okay, it's in this case in the new 2021, you have the option to either refer back to the 2019 W-4 form or the 2020 W-4 form. Okay, and with those, okay, the slight difference is, did you check mark that box in number 2? All right. Because that's going to determine you what table to use. But in this case, I gave you everything that I give you in this class. I've already selected the table, so you don't need to look for the table itself. Okay, but I have provided to you on the Google Classroom the actual full publication 15T, which gives you all the federal income tax withholding methods for calculating tax. Okay, and here it gives you pretty much descriptions on which tax tables to actually use. So if you are using a payroll system such as QuickBooks, you need to use this table here, which is for automated payroll services. Okay. And that's going to be this table right here. So each one is going to be broken down on a specific criteria. So again, automated payroll services or systems. Okay. You're going to follow each of this because all of this is going to give you a step on how to calculate it. All right. Now again, reading this will make you more confused. So I have a PowerPoint set for you on how we can calculate this. And here's the table that you would use for an automated payroll service. Now, once again, you have this one. You have bracket method, which we're not going to learn, right? As you can see, the tables just keep going on and on and on. I don't need you guys to know that one. I want you guys to know the percentage method, okay? Here is another bracket method. I'm going to skip this one forward. Now, there are two different ones because, like I said, there's ones where you can claim for W-2 forms either prior or later. So this one, we're gonna be taking a look at percentage method, okay, for manual payroll systems for W-4 forms for forms 2020 or later. So this is the tables that we're going to be using. So the table number 4 is what we're going to be primarily focusing on. But this entire payroll, this tax table gives you every scenario for both bracket and percentage method for both manual and automated services for both W-4 form for 2020 and later and W-4 form for 2019 and earlier. So once again, this tax table, it's provided to you for you if you're interested in just learning and seeing the difference between a lot of them, okay? You could use this to practice on your own taxes, okay? Or on your own income, yada, et cetera, et cetera. But like I said, we're going to be focusing on only number 4. And for every scenario that we do, whether it's on the test, exam, or the exercises, I will provide you the table. Okay? I will provide you the exact table so you know which one to look at instead of giving you a whole bunch of tables and you have to figure it out yourself. No. In this case, payroll is very difficult, especially, think about it, if every individual is going to give you a W-4 form. One person's claiming that they're single. The other person's claiming that they're married. The other person's claiming that they got 3 dependents. Think about it. You're going to be flip-flopping over to 4 or 5 separate different tables. Okay? And it's going to give you a headache because every individual is going to have a different needs. So that means you're going to be calculating every individual completely different. Okay? All right. So once again, I provided these tax tables for you so you don't need to look it up. Okay? But yes. All right. So that is the circular E table. Okay? And I gave you guys the most up-to-date 2021 version. All right? Now, let's see. Okay. So let's talk about how we actually use this percentage method and actually how we're going to claim it. All right. So step 1 tells us we're going to be determining how much that individual has actually earned. So this is where we're going to be calculating gross earnings. All right. And we're going to be taking it and getting all the information that's on their W-4 form. We're also going to be taking out how often we pay them, okay, and what filing status they are, and based on what criteria they fall under, is going to determine how much percentage you're going to be taxing them at. Okay. So once we do that, right, and that's the whole step here. We're gonna go through each and every individual one. Now, once again, to make this class as simple as easy, right? Because not everybody on the W-4 form is going to claim that they have a secondary job. Okay, not everybody is married. Okay, so in this case, step 2 is going to be for this class. I'm going to make them all 0. Okay, I'm going to say that they're not going to have a second job. They're not going to have any extra deductions that they can take. So in this case, step 2 is going to automatically be zeroed out. So we're going to go from step 1 to just determine how much that they earned in the year. Okay, and then the next step here is going to be determining their which bracket, or in this case, which percentage that they belong into. Okay, and once we do that, that's where we have to start calculating how we actually calculate the taxes. And then last but not least, if they claimed any children, we need to take them out. Okay, so let's go ahead and dive into this example here. Okay, so here example is that we have L. Okay, she's a single woman with one dependent. Okay, and she only has a primary job. So therefore, step 2 is automatically eliminated. Okay? She's obviously filing for single as well. Okay? And she earns $15.25 an hour and worked a total of 45 hours this week. Okay? And she claimed her dependents. Okay, I put dependents, and has no additional deductions or withholdings. Okay, so once again, the pay period is going to be weekly. And then now step 1, we need to determine her total earned wages, or in this case, gross wages. Okay, so if she worked a total of 45 hours and she gets $15.25 an hour, how much is she going to be? What's her gross earnings?
686.25.
686.25 is correct, right? That's how much her gross wages are. Okay, so once again, because this is her primary job and she's not taking any other extra deductions, that's automatically 0. Okay, so 0 for part A, which is if she has a secondary job, what are her total earnings? Part B is going to be what are the extra deductions and that she is going to claim, or I'm sorry, extra deductions she's going to claim. Nothing. So in this case, we're just going to be focusing on her gross wages of $686.25. Okay. Now step 3 is going to be we need to go determine through the circular E table which percentage she's going to fall under. Okay, so this is where the W-4 form is going to need to come into play, because 1, the table is going to be based on the filing status, the pay period that we're going to pay her, and how much she actually earned. Okay, so if she earned $686.25, this is now how we're going to do it. We're going to take our circular E table. Okay, so again, I picked out this one already. This is the weekly table, and because there are the table split into 2, you have 2 choices. Are you going to take from the single one, or are you going to take it from the in this case the one on the right is if you are doing the 2021 and you claim that number 2 is checked. In this case, where 2 doesn't exist because she doesn't have any secondary job or anything like that, so we are going to focus on the left side. Okay, and this is single status. Okay, single status. Okay, now we're going to go determine this. We need to take her gross earnings and fit it between A and column B. So she earned $686.25. So the first column asks, did she make more than? Okay, definitely more than $0, definitely more than 241, definitely more than 433, but not more than 1,021. So we got to bump it back up. Okay, so $433. She earned more than that, but she did not. She definitely earned less than 1,021. Okay, so that means this is the row that we're going to be focusing on. Now let's follow that row through. So this row right here tells us, C tells us how much the IRS is going to take away from our paycheck regardless. This is the flat rate that they're going to charge us or take away from our paycheck automatically. Okay? Anything in excess, okay? So they let you keep $433 for yourself, and any dollar that you earned extra is going to be subject to a 12% tax. Okay? So once again, when you find your bracket or you find your row, that fits between A and B, if she earns more than this but earns less than this, your first thing that you're going to do is you're going to subtract out letter E because that's how much the government is going to allow you to keep. Any money that's extra, any dollar after that is going to be subject to be taxed at 12%. And then you're going to tack on additional letter C, which is what the government's going to take away from you regardless of how much you've earned. Okay? So let's go ahead and take that into practice. Okay? So first thing is that we claimed that she fell into that row. So therefore, $686.25. We get to claim $433. That's what the government lets us keep. Okay? So then now in excess, we have $253.25. This is going to be subject to that 12% tax. So you're going to take that $253.25, multiply it by 12%. That's going to give you $30.39. Okay? And because the government's going to also take away money regardless of the amount that you owe, they're going to take an additional $19.20 because that's what the bracket shows, right? It shows that they're going to take $19.20 away from your paycheck regardless of what you earned. Okay? So that's how this system works. Once you find your excess that you've earned, you're going to multiply it by the percentage, and then you're going to add what the government's going to take you away from automatically. So in this case, we're going to add those two numbers together to get a grand total of withholdings to be $49.54. I'm sorry, $49.59. Okay? Now that doesn't stop here because now we need to claim our dependents. Okay? So in step 4, let's take a look. She claimed one dependent. So that means she has one child. All right? Now we got to take a look at her W-4 once again. So this is her W-4. She claimed one child. So that means she's subject to $2,000 already. Okay? What you're going to do is you're going to take that $2,000 divided by the number of payments that you're going to have. So in this case, we got $52 paychecks, right? Because she's getting a check every week. So in this case, her total that she gets to take away from this withholding is going to be $38.46 because she claimed a child. So if this is going to take away from the amount that you're withholding, it's going to be deducted from the $49.54 to leave the tax that she has to put in for $11.13. Okay? That's how much you can withdraw from her account that because she is claiming her child, which is going to cost $38.46 per paycheck. So therefore, she's only going to contribute $11.13, okay, as her federal income tax withholdings. Okay. Any questions here?
With the child, wouldn't she be filing head of household?
No, you don't have to. All right, because I know there's a lot of individuals out there, right, who live with somebody, okay, and they're not the head of household. She could have claimed head of household if she wanted to, but in this case, she didn't. Correct. Correct. Okay, so if she wants to claim as a single woman, she can do that. But once again, she might not be the head of household. She could be living with, her parents. Right? And that would make her parents the head of household. not her.
So this 4,000 and $2,000, is it already given, or who gave this number?
This one, yes, it's on the W-4 form. It is given because apparently by IRS terms, they say that each child is going to cost you $2,000 per year. Which, I mean, in reality, we know for sure a child does not cost $2,000 a year. That's how much you can claim per child, is what they're essentially saying. Okay. So again, it's going to be, I did a typo here. It's going to be for $38.46. All right. And that's going to go against your paycheck, or in this case, it's going to go against the deduction for the federal in tax withholdings. Okay. Now, back then, children were taken out prior. It was taken out before taxes. But now, they're claimed after taxes. Any questions? Okay. So, with that being said, that is her total withholdings. It's going to be for $11.13. So, I'm going to stop here because we are due for a break. Okay. So, it is now exactly 10:15. Let's go ahead and take a nice 20-minute break.